And I think we're going to go ahead and get started. So, good evening, everyone. Thank you all so much for joining us tonight. On behalf of Build Up Justice NYC and Grow Brooklyn, we truly appreciate you taking the time to join us this evening. I know tax season can be stressful and a confusing time of the year, so tonight we're going to be demystifying parts of the tax filing process. And make sure that you have the information you need to file your taxes accurately and with confidence. This is the second session in our three-part series, and tonight we'll focus on tax credits and refunds, reviewing important terms, and making sure you're not missing out on any money. We're also going to share resources where you can obtain trusted support and services. For those who may be joining us for the first time, my name is Teresa Shire. I'm the grant writer and development coordinator here at Build Up Justice NYC. Build Up Justice NYC, or formerly known as Brooklyn Legal Services Corporation A, provides free community-centered civil legal services to low-income New Yorkers across all five boroughs. While our name has changed, our mission remains the same: to advance economic and racial justice by preserving stability and long-term security for tenants, homeowners, small business owners, and families. Our work spans three core programs. Our Preserving Affordable Housing program helps tenants stay in their homes through eviction prevention, anti-harassment advocacy, fair housing claims, and access to essential services. Our Community Economic Development program supports small businesses and nonprofits, providing commercial lease assistance, advice on laws and options, negotiating rent and arrears, and anti-harassment advocacy for commercial tenants. And our Consumer and Economic Advocacy program helps individuals and families build financial stability. So this includes preventing foreclosures, resolving tax issues, and offering wills and estates planning. Under this program, we also have a domestic violence team that assists with obtaining orders of protection, child custody, and support. And tonight's program is part of our consumer and economic advocacy work. We're also proud to partner with Grow Brooklyn, a community-based organization dedicated to strengthening Brooklyn residents through financial empowerment and housing stability. Grow Brooklyn provides free services, including housing counseling, foreclosure prevention support, homebuyer education, financial coaching, assistance navigating mortgage and property tax challenges, and more. Their work helps community members grow and preserve their assets, helping to build economic security. And we're especially excited also to be joined by a representative from the Internal Revenue Service who's here to provide accurate information and help answer your questions directly. Now, before we begin, we'd like to take a moment and sincerely thank all of the sponsors and partners who helped make tonight's program possible. Their commitment to education, outreach, and community empowerment makes events like this accessible to those who need them most. So, big thank you to Senator Roxanne J. Prasad, Senator Leroy Comrie, Assemblymember Lorinda C. Hooks, and New York City Council Deputy Speaker Dr. Natasha Williams for their partnership. And now I'm so pleased to introduce Senator Prasad, who is joining us tonight. Senator Prasad has been a longtime champion for our community, advocating for safer communities, affordable housing, small business assistance, supportive services, and more. We are truly, truly grateful for her partnership and leadership. Senator Prasad, thank you again for taking some time to be here with us tonight. Would you like to share a few words?
So good evening, everyone. Hello from Albany, and where it is very cold and the snow has stopped. It was snowing earlier. It's great seeing all the familiar faces here. This is something that I enjoy partnering with so that we can keep our communities informed. And this is a great thing. So I want to say thank you to Build Up Justice and Grow Brooklyn and the IRS folks. They're in my office. They've been in my office. I think we've been doing this a couple of years now. And so we're always grateful that you can come on and share the information with our constituents, because we do not want anyone leaving money on the table. And when they do not have their taxes done correctly and they do not know all of the things that they claim, they are technically leaving money on the table. And so your conversation this evening is going to guide them so that they understand that every penny left on the table is a penny too many. And so, again, I want to say thank you. I want to thank my colleagues, Senator Leroy Comrie, Assemblymember Hooks, and Council Member Dr. Williams. I have to remember to say Dr. Williams to make sure she gets that title. She earned it. And so this is something we all believe in. And so we will continue to work with you and, in the work that you're doing. I will see you when you come to my office on Saturday. I know you're going to be at my office on Saturday and some other days. But again, I want to say thank you for all of the work you're doing, not just in the this informational space about taxes, but across the genre of things that you do. So again, I want to say thank you. And to everyone who is joining, the information that you're going to receive this evening, make sure you share it with others. It is great information for you to share. All of your friends and your colleagues and your brothers and sisters who could not join us this evening, we want them to know the information. So please, again, share the information, share the resources, and let them know that Build Up Justice and Grow NYC are resources that they can trust. So again, I want to say thank you and have a great session this evening, everyone. Thank you.
Thank you,
Thank you,
Senator, and thank you
Senator.
for sharing those words. And again, we couldn't organize these events without your support and partnership, so thank you.
You're welcome. Have a great webinar.
Thank you. It is now my pleasure to introduce Max B. Trezel, Senior Stakeholder Liaison with the Internal Revenue Service. A little about Max, he brings over 20 years of experience in education, public service, and federal government throughout his career, from the New York City Department of Education to the U.S. Census Bureau during the 2020 decennial census, and now with the IRS. He has focused on strengthening community partnerships and expanding access to economic opportunity. In his current role as Senior Stakeholder Liaison for the New York area, Max works closely with community organizations, employers, and tax professionals to provide outreach, education, and trusted information directly to taxpayers. He is fluent in multiple language and deeply committed to ensuring communities receive accurate, accessible information from the IRS. Max, thank you for being with us tonight. We're so grateful that you're here to share your expertise with our audience. I'll turn it now over to you.
All right, thank you very much. I appreciate that. You make me feel important. Wow. So, as you know, I work for the stakeholder liaison. For those of you that just, this is a part of iOS, the divisions of communication and liaison that create the bridge between you and the iOS. So we work for the iOS, but we are the face of the iOS. So we are the one that if there's an issue that you can contact so that we report that to the iOS for the issue to be solved. As you invite me today, we're talking about refundable and non-refundable credits. You can see on my slides. My name is Max B. Don't ask me for the B. If you know Max Bless, you just say it like this. So my middle name, just say Bless. All right. So can we move on to the next slide because I don't think I have a lot of time. So the time that I have, I'm gonna use it wisely. So we have a refundable tax overview. As you know, non-refundable tax credit provide dollar for dollar reduction to the tax liability. So what does that mean? If I own iOS $1,000, like $1,500, and then I have a $1,000 non-refundable credit, which means I will pay iOS $1,000 with my credit, then I will own $500. You understand that? But if it's a refundable credit and I have $1,000 credit, so I will have a refund of $500. I hope this is clear for everyone. So a refundable credit can reduce tax liability and result to a refund, but non-refundable credit reduce your tax liability. So I want that to make sure that everyone understands this. So refundable credit. The refundable credit we will discuss today is earned income tax credit, child tax credit, American opportunity tax credit, premium tax credit, and adoption tax credit, which is very new for some of us. Can we? So, no, no. We need to. We need to. Okay, good. Sorry, I didn't see it because I'm on my phone. Sorry for, and some of the future they take time to get. For 2020, for 2025, the maximum credit amount you can claim, because the ICDC said 2024, this is a typo, all right? Earned income credit, the maximum you can claim for 2025 is $8,046, all right? That reduces the burden of supplement for the ways of working family. You can receive a refund with this credit, even though the taxpayer has no filing requirement, owned no tax, or had no income tax. And you might ask a question sometime, how come I don't have a filing requirement and are still receiving a refund, and because you have refundable tax credit. So if you're in the audience and you will listen to us, speak with your tax professional. They will explain that to you more because they either you pay them for that or they volunteer to help you. Let's move on. Next slide. All right. So you see, to be eligible for earned income tax credit, or qualify for the income tax credit, there's a income limitation. I will show it to you later. You have to have a social security. You must be a U.S. citizen or resident, or you must have a qualifying child. Be at least age 25, under 65 at the end of the year. Live in the United States in more than half of the year. No qualify as a dependent of another person. And this is from the publications 5998. I want you to please, if you can write that, this is information from directly from iOS, and you can get the publication just on Google, and then you Google publication 5998, it will pop up. And if you want to know if you qualify for EITC, there is a link below. I don't know if you're able to have the link. You just click and put your informations. Or uh, we have something called interactive tax law. You can ask questions. It's like an AI. It tells you exactly if you qualify for EITC or not. Let's move on. Okay, this is the table I wanted to come. Some of the requirement to earn or to have or to claim an income tax credit. If you have zero dependent, you need to make at least $19,000, and you can if with zero children you can earn about $649, and so on. If you have one child, it has to be your income, your AI. Well, in our language, we say the adjusted gross income must be $50,000 or to oh, if you're married, $57,000. If you file marriage function, and two children is 7,000, and three children you can claim up to $8,000, but you must be three children's anyway. So those are the information that come from directly from iOS. That it's like a good news to use. Let's move on. All right. We also have child tax credit that provide $2,200 for a qualified child. The parents, for foster parents, siblings, or grandparents who can claim a dependent. A special rule exists for children divorced. That's something else that you can talk to your tax professional. Dependent who do not qualify for CTC may qualify for non-refundable credit, like other dependent. As you know, we have a lot of credits. We have a list of non-refundable credit, a list of refundable credits. How to determine eligibility and claim the credits? This is a link that I put there. It's called Interactive Tax Assistance. You can go directly, you can go to ios.gov, you put Interactive Tax Assistance, and you click on it. You can play, you can ask questions, and they will automatically answer the question for you. Okay, let's go. And to be qualified or qualified, you need to be under 17, live with the taxpayer for more than 6 months, all right? And then there's special rules that apply to divorced child or filing separate, did not provide half of the own support, meet the relationship criteria, in a U.S. citizen, national, or resident, have a valid social security. Those are important because I believe those informations are very clear. Anyone can understand that. If anything there you don't understand, please talk to your tax professional. And the publication 5811, this is where this information comes from. And this is, you can just Google publication 5111. That's where the information, those are information that you can use. All right, next. All right, this is my American Opportunity Tax Credit. I take advantage of it, and I'm sure most of you, or you may be very old. You went to college a long time ago. Most of you take advantage of American Opportunity Tax Credit. They provide like $2,500 credit for eligible student, but to be qualified for education expense, eligible students must be first 4 years of higher education. Qualify for expense, tuitions, requirement enrollment fee, books, supplies, and equipment needed for the course of the study. That's pretty simple. And let's move on to this. And then we have, uh, you know, let's repeat that. The publications for the qualified student for the American Opportunity Tax Credit AOTC, publication 4772, pursuing a degree or other recognized education. Enroll at least half time for the least 1 year academic period, and then not have finished the first 4 years of higher education at the beginning of the tax year. Not have a felony drugs convictions at the end of the tax year. This is pretty simple, all right? Let's move on to premium tax credit. The premium tax credit help eligible taxpayer pay for the health insurance purchase through the health insurance marketplace. And sometimes this is very tricky. And when I used to work on the office, people show up with the sometimes they send back the tax because they don't have the form, the 1095A or 1095B. The 1095B, if you work, they pay for insurance is already automatic. But some people have problem because they send back the tax because they don't have it. This is very important for the taxpayer to keep the record of it if they purchase the insurance on the marketplace. This is very important. And this is a refundable credit that can reduce your tax liability and produce your refunds. Let's move on. And then this is very new for us. You have a adoption credit. If you adopt a child, you may be able to claim the adoption credit of income inclusion from employer. That's exclude from an employer provided adoption benefit. Qualified adoption expenses are limited to $17,000, $17,280 for qualified 2025. While a qualified child for the adoption credit must be under the age of 18, physical or mentally incapable of self-care. You cannot claim the credit for expense related to adopting your spouse's child. That's for sure. You cannot do that. And the $17,000 you see that mentioned up there, it's mean 5,000 on it is refundable, and you have 5 years to claim the remaining portions of the 17,000. And qualified additional expense are reasonable and necessary for expense you paid for adoption fee, attorney fee, court fee, travel, and other expenses directly related to the adoptions, and expense paid before identifying or eligible child. That's a very important. And the link is attached with the PowerPoint as well. And when you get a chance, you can open it and read it on your own, because does a good job in making sure that the informations are in plain English that anyone can read them. Let's move on. So those are the link that I provide for you. I don't know if you have it, and you might receive it. And the tools that we use, you have your account online. This is for individual. Get your transcripts, earn income tax credit. Those are the link to see if you qualify. Tax withholding estimator. This is for people that self-employed to estimate the withholding. Taxpayer assistance center, you can locate them. You just put your zip code to see which one is close to you. Business tax account, then that you can see your transaction between your business and IRS. And tax pro account, you can receive your demand from your clients, and you can intervene because the tax professional, they have direct access to IRS. They can provide you service. And we also have irs.gov/help. We have irs.gov ITA, that the one that I talked before. uh, ITA, Interactive Tax Law. This is a tool that we have to answer questions and topics related to taxes. And if you need a form from IRS, irs.gov/form, and even the newest form we have, Schedule A1, Publication 17, explain too, because me, before I get to IRS, I had to read this big book called Publication 17, so that you master from the schedule, the tax form, and everything about the individual tax. I believe that's it for me. Thank you very much. Uh, thank you, Maria. This is my email below, and if you have any feedbacks, information that we provide that's not correct, or any information that you will see that's not correct from out there, or you can send me an email, and I will make sure that that get to the executive. That's part of my job, and thank you very much. Hopefully, people that are coming after me, they that's what they do for a living. They will explain you more, because me, I'm not allowed to do the tax. I can only give you the informations, and the people that hands on the tax every day, that's what they do. They have more experience doing the tax than me. They can explain you everything, and like she said before, missing a dollar is everything, because some people really need it. Uh, a dollar is more than no dollar. That's what I want to say. Thank you very much.
Thank you so much, Max. It's definitely so helpful to have a member of the IRS present with us today. Before I turn it over to Grow Brooklyn, just a few quick housekeeping notes. We will be sharing out a recording and a copy of the slide deck sometime to you next week. So Max mentioned and included a lot of great links that you can all use. You will have those links in due time. We will be sending those out. We'll also have a Q&A session at the end of the program. So as they arise, please feel free to type your questions into the Q&A box on your screen at any time. When we open the floor at the end, you may also use the hand raise feature if you would like to ask your question verbally. And we'll do our best to answer as many questions as possible this evening. But if we are unable to get to your question, rest assured, we'll provide contact information so that you can follow up. So with that, I am very happy to introduce Executive Director Makila Brathwaite and Taxpayer Experience Rep Takia Smart from Grow Brooklyn, who will kick things off for us.
Good
Good eve-
evening, everyone.
good evening, everyone. I'll be starting um, with our slides with you today, and we're going to be starting with explaining to you about deductions. Next slide. So what is a deduction? Um, all of us get part of our income, regardless of how big or small that income is, that's not going to be taxed, and that's called a standard deduction. So a deduction is a way to reduce your taxes, the taxes you're going to pay. It's taken off the taxable part of your income. And there are different types of this of deductions. Everyone gets a deduction, and that one is the standard deduction. The amount of a standard deduction is based on your filing status. So everyone is going to get that off the top of their federally taxable income. Additionally, you also can take off qualified expenses. If you have certain medical expenses, that counts. And for those who run their own businesses, what you will call tax write-offs. So you get to take that off your income, and it lowers your overall tax responsibilities, right? So as the example gives you, the example says that if the money you collected, or the taxable part of your income was 40,000, and then your deductions altogether happens to be 10,000, then you'll be taxed on the $30,000. And the IRS usually determines what's your tax liability for that year given your income, right? Um, if you're itemizing your tax return instead of using the standard deduction, or you don't have a business, some of the tax deductions include state and local taxes, charitable contributions, mortgage points, and as I mentioned before, medical expenses. You would stand, you would itemize your tax return if your expenses happen to be more than the standard deduction that you're already eligible for. Next slide. As I preempted, standard deduction versus itemized. So most people do use their standard deductions because the standard deductions are fairly high. For example, a single filer for 2025, the deduction is $15,750. And most people don't necessarily have personal expenses that exceed that amount. So they still get that deduction, right? So how you make the choice between itemizing or taking the standard deduction depends on which will give you the best outcome with your taxes. Itemizing means that you have to keep track of all your documents and your various exam and expenses to see if it's worth it to do itemized tax return to see that it exceeds the standard deduction. As I already mentioned before, what comes into itemizing your tax return and why that's beneficial. So the next one, medical expenses. Medical expenses, you can deduct medical expenses that exceed 7.5% of your adjusted gross income. For example, if your adjusted gross income is about $40,000, right? And you have medical expenses up to $5,000, you can only deduct the amount exceeding $3,000, which is 7.5% of the 40,000. So about 2,000 will be deductible in this example, right? Um, this would include doctor's visits, hospital bills, prescription medication, and your health insurance premiums that you personally paid. So if your income is it's the 40,000 is our standard we're going with here, right? Medical only the medical expenses that exceed that go past the 3,000 will count. Right? The next one is the mortgage interest. If you own a home, you pay interest on a mortgage, you may be able to deduct that interest. And you usually get a form in the mail for the mortgage interest. A lot of times, from my experience, when you're doing your taxes, even if these numbers don't come up, as a New Yorker, it is still beneficial to add this information to your tax return because even if it may not help you on the federal side, the state side is its own entity and it's different. So deductions and stuff are even different on the state side. So it may come into play. So like some people have gotten the deduction based on their mortgage interest on the state side of their tax return, but they did not get it on the federal side. So this is why it's important to keep track of all your documents anyway, because as New Yorkers, even if you do not get certain credits or benefits from certain expenses you have, the state side may give that to you. Okay. Charitable donations, and again, you have to keep records for everything you're claiming. So cash donations, clothing, household goods, anything that you get. Now, there's a special thing for disaster losses. Usually it has to be a federally declared disaster. It's something you actually have to, you can go on FEMA and look up. And there's usually a number that goes along with that if you're filing for that. So you had to have been in a disaster zone and you had to have filed and make that claim for having been in the disaster zone. I believe there's a certain period of time they give you to be able to do that, but I'm not sure. So, if your area was affected by major hurricanes or flood, fires, earthquakes, anything like this, but there is on the FEMA site, you will be able to input your address to see if that counts to you, and you have to actually apply for that also on their site so that you get a specific number that you get to then put on your tax return. You have to use on your tax return if you're claiming that you were in a disaster zone. Most often, too, you get a longer period of time to file your taxes based on that. Next. Oops, next. So what is a tax credit? Um, so we talked about some of the credits before. Max talked about credits before in his presentation. And so a credit is um, is is something you get mostly if you're low income that you get credits. So based on your income, you get what Dax talked about, the earned income credit, right? That is a low income credit and there's a threshold. If you make over a certain amount, it's you phase out. You no longer qualify for those credits. If you are a student in school, you get certain credits. So the difference between a tax credit and a tax deduction is that a credit is helps you if you owe or it helps you get a refund versus the deduction comes off your income and lowers your tax liability from the onset. And that's the difference between a tax credit and a deduction. Next, the refundable versus the non-refundable credits, right? So this was already touched upon. Some credits are fully refundable, some are fully non-refundable. There are actually some credits where part of their credit is actually refundable up to a certain amount. And as was explained before, um, non-refundable credits help you for if you owe. So if you have a tax liability for that year, the non-refundable credit will impact the tax return only in that circumstance. When you get in a refundable credit, it impacts your refund regardless, meaning that you will get that credit. It will be applied even if you do not owe. So if you already have a refund of $1,000 coming to you and you are getting, let's say, the child tax credit, you're getting $500 of the tax credit, the child tax credit. I believe that one is refundable because they change certain credits to be refundable. Let's say the earned income credit is refundable, then you would get that $500 on top of the $1,000. Versus if the credit was non-refundable and you are rewarded the $500, it would not impact the refund you're getting. But if you owed the IRS $1,000, it will reduce your tax liability for that year. Next. So some of the major credits, everybody comes in asking about the earned income credit. So to get earned income credit, you have to have earned taxable credit income. And the thresholds, we can go on. I think you were given links for the thresholds, meaning the maximum amount that you must make before you phase out. Am I on the wrong? I'm looking at the wrong
You can skip forward to child
Okay, I got
independent
it.
care.
Sorry. Um, all right, so child and dependent care credit. So the child care credit, the child must be 13 and under, and it you only get the credit for if you're paying for like child care. If you put your kid in some sort of enrichment program and stuff, it doesn't count. It only counts specifically for child care for children up until the year they turn 13. For or if you have an elderly person that is your dependent that you put into some sort of daycare or you pay for someone to come and take care of them, that's where the dependent care comes into, or if you have a child that is considered, an adult child that's considered disabled, that needs care. To claim the credit, you must have the EIN for the business, you must have the provider's name. It is recommended for the phone number, but not required. But you must have their, either if it's an individual, their social security, their address, and the amount that you paid them for the year. And of course, if it's a facility of some sort, they will provide you with their tax information for you to be able to claim the credit. And that also actually includes like summer camp you put your kids in for the kids who are under 13. So when you put your kids in those like day camps or even overnight camps for the summer, they also you can also claim the credit based on that expense. Next one. Education tax benefits. So the three ways that you get a credit from education is while you're in school. So that's the American Opportunity Credit as well as the Lifetime Learning Credit. And then after, when you're actually paying back your student loan. So when you're paying back your student loan, there's interest that you pay. They usually send you a tax paper. The American Opportunity Credit is for those who are working on their first bachelor degree. It is only for your first bachelor degree. If you're getting a second bachelor's degree, it does not count. If you're working on your master's degree, it does not count. That's when you'll go into the lifetime learning credit. So anything that's not a four-year degree, a bachelor's degree from an accredited institution goes under the lifetime learning credit. And this counts for even if you're getting like certification, you're going to beauty school, you're going to any sort of education that you're getting, you claim under the lifetime learning credits. If you're working on your master's degree, your second to third bachelor's degree, working on your PhD, you could claim the lifetime learning credit. The lifetime learning credit is not refundable. And with the American Opportunity Credit, it is partially refundable. So you get a certain part of it up to a certain amount, and then the other part it's non-refundable as refundable, and then the other part only impacts your tax return if you owe taxes, as we talked about before with the non-refundable credit. Um, the one you get from the student loan interest, in my experience, it really does make an impact in terms of the percentage, depending on how much you pay. You've been paying off your taxes. Of course, there's a maximum that you can claim on this credit.
Great. Thank
Thank
you.
you. Thank
Thanks, Takia. I'll talk a bit about refund offsets. Refund offsets is something that isn't always talked about, and a lot of taxpayers get surprised when they notice a reduction in the refund they were expecting. So, what's an offset? An offset happens when the US Treasury takes your refund to pay certain debts. Generally, they're governmental debts. And it's not random, it applies to the specifically child support, defaulted student loans, state income tax debt, and things like unemployment. Maybe you used too much or you used unemployment you weren't entitled to. So sometimes that occurs. Then we also have things that are not offset, which would be like if you have major card loans or medical bills or private loans or utility bills. Generally, those are not offset. Though we did have a client come in once who had Sprint offset something for their New York State, but that might have just been his particular circumstance. But if your refund was offset, the first thing you tend to do is talk to your tax preparer. The tax preparer will tell you to check with the Treasury, and will give you a phone number to call so that you can find out why your return was offset. Sometimes we will know, but more than likely, it's best to talk to the Treasury directly. Next slide, please. So we talked about student loans being offset, and it's important to know that just having a student loan doesn't mean the government is going to take your refund. The tax refund is only going to happen if the student loan goes into default. And default means that the borrower, you, has not made any payments for about 9 months, around 270 days, and the loan has moved into collections. So that's important to note if the loan is moved into collections. So it's really considered a serious delinquency. And it's not like if you miss one or two payments, but it's once it's moved into collections, that means you just have been putting the bill on hold. We know life happens, so that's happened to a lot of people. But the government is going to try to collect by first seeing something that they can see, which is that tax refund, that federal refund. So you have to understand that you may think you're getting a refund of $2,000, but you may owe that same something on your student loan that you've defaulted on, and they will take that. So that's something to keep in mind. Next slide, please. So New York State also has specific offsets similar to the federal government. It's past due child support, any back taxes you may owe New York State, unpaid traffic tickets or court fines. Then you also have the public assistance overpayments. Sometimes they may give you a little more than you're entitled to, or they maybe something has changed in your circumstance, but they did not make any changes on what they paid out to you. So that will get you an offset repayment. And again, with as with the federal government, what's not taken out is the credit card, medical, private landlord judgments, or private loans. And you will generally get a letter explaining that you owe this particular entity and that you will get some kind of payment taken away from you. But you must be vigilant and see these types of things, because a lot of times we tend to get letters from these entities and we don't pay attention to them. But it's just like with the property lien. A lot of times we just look at the letter, we know what it is, we know that we owe someone, and we're not able to deal with that at the moment. But just know that come tax time, they will take your refund if you get one. You know, the tax preparer may do all their due diligence, find all the credits that you're legally entitled to, and you may be looking at what you think is a large refund. But if you owe these entities at all, understand that that may be taken by the government. And sorry for that depressing part of tax refunds, but it has to be said.
Yeah, so thank you, Grow Brooklyn, and again, Max from the IRS for that presentation. That was so helpful. My name is Kelly Lai. I'm a staff attorney at Build Up Justice NYC's Consumer and Economic Advocacy Program. So specifically, I'm going to be going over dependents. Next slide, please. So there are essentially two types of dependents. So you can either have a qualifying child or a qualifying relative. So a dependent really just means someone who relies on you for your financial support. So we want to make sure if you're taking care of someone, whether that person's related to you or not, that you are able to claim the maximum amount of refund. Since the number of dependents you have also, the more dependents you have, the more refunds that you'll likely get. So for a qualifying child, there are different rules that apply for a qualifying child. But the general rules for dependents is that this dependent has to be a US citizen or a resident alien or national or resident of Canada or Mexico. And this dependent cannot be claimed by anyone else. You're the only person who should be able to claim this dependent. And the dependent cannot have their own dependent. So if you're taking care of someone, this person shouldn't also be taking care of someone else under him or her. And the dependent cannot file married filing jointly if this person's dependent on your tax return. For a qualifying child, so to qualify as a dependent as a qualifying child, the age has to be under 19, or if the child is a full-time student, then under the age of 24. And to be qualified for, or to be considered a full-time student, the student has to be enrolled in a number of courses to be considered full-time at this credited school. If the child is permanently or totally disabled, then there is no age limit as long as there is the permanently and totally disabled qualification. Regarding relationship, so the child has to be related to you in some way or form. So the category is quite broad. So it can be either your children, siblings, step, half siblings, foster children, grandchildren, nieces, or nephews. But the child has to be related to you in one shape or form. It can also include adopted children, but the adoption has to be legally done with the papers or foster children with the state and local agency. For residency, qualifying child has to have lived with you for at least 6 months of 2025. There may be some exemptions. For example, if the child was away from home due to an illness or hospitalization, that still counts towards that 6 months period. And as the name says, the child is your dependent, so you have to make sure you have supported child and provided more than half of the financial support. For a qualifying relative, the age isn't, there is no age limit for a qualifying relative. So if someone who is your dependent but doesn't fall under qualifying child, likely this person will fall under qualifying relative. So the relationship doesn't have to be specifically biological relationship. If the person has lived with you and is a member of your household and you have provided more than half the support, then this person can count as a qualifying relative. There is an income component. So if this qualifying relative has had gross income more than $5,000, then unfortunately, this does not count as a qualifying relative. And again, if you're in doubt, make sure you contact a tax professional just to go over the rules specifically. Next slide, please. So there may come situations where more than one person is claiming the child. So the general rule is if you are the parent and the other person is not the parent, then you have the right to claim this child. If two parents are both trying to claim the children, then generally the children who has lived with the parent longest, that parent should be claiming that child. If the time is about the same, then the parent with the higher income should be claiming that child. And if both of the people who are they're not the parent, then the person who's not a parent then is allowed to claim the child. So we've definitely seen a lot of cases where, especially people who are victims of domestic violence, where the other abusive spouse is trying to claim the child. And the IRS does not have determination once you file. Usually they immediately accept it, even if that person really does not qualify. So in these situations, we always recommend taxpayers to make sure you have records of your children living with you. So you can prove that by having doctor's letters stating that you're the guardian, or school records, or any custody orders. Just make sure you have that ready. So let's say for 2025, if you want to make sure that you have proof of residency, in the letter itself, you would just say, in the tax year of 2025, this child has lived with me. I'm the guardian and I have provided more than half the support. So something of that form is acceptable for the government just to show that you should be the one claiming this child, as this really does impact the refund amount. Next slide, please. And right now, there are a lot of scammers out there, unfortunately, who are phishing. And I don't know if Grow Brooklyn, you want to go over this slide?
Okay, I'll take this. Okay, so basically, we want everyone to know that your greatest asset is your identity. When people think about assets, they think about things like a car, a home, a savings in a bank. But really, truly, your identity is a key to everything. It's key to work and income, a key to opening bank accounts, applying for housing, receiving tax refunds, access to benefits and services. And without your identity, any things fall apart. So we want you to understand how important it is to guard your personal identifying information, your PII. That's your social security number, your passwords, your date of birth, tax information, and any cards associated with that, such as your ID cards. You should be wary of folks who are phishing, because a lot of times they're sending you these text messages. Oh, the IRS wants you to give us your information, your AGI. And then, once you reply to that text message, then with your information, they have not just your phone number. They know that's the correct phone number, but they also can get your AGI through that because you willingly gave that to them. So you must be very vigilant with what's going on. The IRS never, ever contacts you by email. They do not call you. You may get a call from a tax prep company such as Grow Brooklyn, but you know that Grow Brooklyn is a part of the IRS certified VITA programming. So would definitely accept a call from us, but the IRS specifically is not going to call you to ask you for any information. And sometimes our guard may be down. Maybe we are expecting information about a refund. But what we'll do, instead of answering that call, we'll just let that go to voicemail and then call the IRS directly to find out, or call the bank directly rather than call, if Chase Bank, for instance, shows up on your they call you and shows up in your call history, you might be curious, okay, why is Chase calling me? I have a bank account there. But you definitely want to make sure it's Chase by you calling the actual Chase number back. If you have to do some research to make sure that it's the right number, you do that. But you do not fall victim to these predators. That is their job. Their job is to scam you, and a lot of them are very good at their job. So let's make it our job to thwart all these efforts by guarding all of our identity and making sure our information is sacred to us. And at our tax sites, we make sure that we put away all of your tax files. When you come to us, everything is locked away. The IRS comes to our locations to make sure that we're following those rules. And all of us being IRS certified volunteer preparers, we make sure we follow those rules to the letter. So even if you do not choose a Grow Brooklyn tax site and you choose another site within the New York NYC free tax prep world, you will understand that we are all under those same rules, where your PII is very important to us, and we make sure we guard that, and we ask you to do the same. Next slide, please.
Thank you, Michaela. So to provide an extra protection, there is this IRS number that's called an IP PIN. So it's a 6-digit number that you can request online with the IRS account, or you can also file an application to request this IP PIN. So this is a 6-digit number that you will need so that you can file electronically. Make sure you keep this safe once you receive it from the IRS. It can either come through online or by paper mail. And make sure you don't share this with anyone else so that no one else can use your information to file your tax return. And it does change every year, so make sure you look out for in the mail if you have applied for it before, or you can check online with irs.gov through id.me to get this IP PIN for you. Next slide. And just a reminder of the important deadlines that are coming up. So April 15th is the filing deadline for tax year 2025. If you need more time to gather documentation, make sure you file by April 15th the request for an extension. A reminder, an extension does not mean you can also extend the time to pay your taxes. After April 15th, the tax penalties and interest will start to accumulate. So make sure if you think you'll owe that you also pay by April 15th. And next, Go Brooklyn will go over the eligibility.
Okay. So a free tax help. Okay. So we have a VITA program. VITA means a Volunteer Income Tax Assistance Program. This is a program under the oversight of the IRS, so it's sponsored by the IRS. The program we use is via the IRS. We provide free, accurate tax preparation to help with low or moderately low income individuals. And we support seniors and people with disabilities in filing their taxes, and we give guidance to avoid predatory tax preparers. We usually do have a pretty good conversation with our tax preparers about their filing. So this, especially with our self-employed tax prep, we actually have a program for that. This is a year-round program that we help small business owners, freelancers, gig workers, self-employed individuals. If you have an LLC, also we can help you, and even those who have a corporation, the S Corp as well. We have a person in-house that could also offer help under this SATP program. For families, the maximum income is $97,000 is the threshold. Um, and for individuals, it is $68,000. Um, if you have been helped by us in the past and you have gotten a bit of a pay increase, still reach out to us to see if we could offer you assistance with your tax prep. Um, self-employed individuals, I believe is if you have expenses up to $50,000 dollars are your expenses. So the income threshold ends up being about the same um, for the self-employed folks. Uh, we during the season we run about 30 locations. Then, and in addition to our regular locations, sometimes we go to a site just for one day and do what we call pop-up locations. We have several sites throughout Central and Western Brooklyn. Um, we have Bronxville, of course. Senator Prasad allows us to use her space to help her constituents. And you can call or go online to our website to get appointments to any of these spaces. We run any 7 days a week between 10 and 9 p.m., given the day. We are running our tax sites, and hopefully one of these would work for you. Again, if you have problems getting an appointment online, you can give us a phone call, and our number is listed here, 347-682-5606.
Thank you. And I'll be going over Build Up Justice NYC, Low Income Taxpayer Clinic Service and Eligibility. Next slide. So for us to be able to represent you, there has to be an underlying IRS issue. So that can be you haven't filed taxes for a few years, or you're currently being audited. There may be an innocent spouse, injured spouse request, or you currently owe taxes and you need assistance with that. So you can definitely call us at the number listed here, 718-487-2300, to make an appointment. Next slide. We also have a drop-in tax table. So it's a 15-minute time slot every other Thursday. You can scan the QR code. So this is just an opportunity for you to have a one-on-one opportunity to speak to someone at our firm to discuss your tax issue in more depth. Next slide. And we also have an eligibility requirement for our low income taxpayer clinic. So your income cannot be more than 250% of the federal poverty guidelines. So this just means for a one person household, that's about 39,125. And then you can look at the table here for two, it's about 52,000. This gets updated every year. We do accept a small percentage of clients, but that's a case-by-case basis for those falling outside this income requirement. Just give us a call. We may be able to at least guide you to hopefully help solve your tax issue. Next slide.
So we are now in the Q&A portion of tonight's program. Thank you so much to all of our presenters. So if you have a question, please feel free to type it into the Q&A box on your screen if you haven't already. And if you prefer, you may also use the hand raise feature to ask your question verbally. And again, we'll do our best to answer all of your questions tonight, but if we're unable to, or if you have a question later on in the night after you've processed some of this information, you can always reach out to us at info@buj.org with your question. I'll just drop that you see on screen, or you can give us a call at 718-487-2300 during our office hours, which are Monday to Friday, 9 a.m. to 5 p.m. So I see two questions in the chat. The first one, EITC, are those maximum or minimum earnings? I believe this might have been in reference to an earlier slide.
Those were maximum.
Thank you.
So if you earn more than what was in on the slide, then you phased out. So it's a sliding scale, of course, for how much you earn, depending on how much you earn under those amounts.
I believe it was in slides 5 of my presentations. They give a table. I don't know if you can go back. So
Yep. Me one second.
Um,
starts 5. This is the demo. Yes. See if you have zero child at 19,104. One child 50,434. Two children, sorry, 57,310. And it's different for filing rate. It's just different. So you can see and you can see the amount of credit that you can claim in the bottom. Like she said, this is the max, not the minimum.
Also, the amount of credit you get, this is not set in
Mhm.
stone. You will get some of this credit depending on where you fall on this. So the
Yeah,
less you make, the more of the credit you get.
exactly.
Thank you. Our second question, how can I get refundable tax credit promised by a solar company?
So number one, the solar tax credit is not a refundable credit.
And
Uh,
that's part of IRA, Inflation Reduction Act. And as of December 2025, they eliminate all these credit. They replaces by OBBA, one big beautiful bills. So this is if you file your tax for 2024, that's something that you can think about. But if it's for 2025, is no longer acceptable, like a EV car, or there are a lot of those credit they're not eligible because they come from the IRA, Inflation Reduction Act, because of the new government, the new tax law that we that. Okay.
Thank you, Max and Takia. Any more questions? I see a hand raised. I'll let you talk. Please ask your question.
Uh, Hi, I wanted to ask, I want to sign up to file for my taxes. Is there a place I can go to file for my taxes? Do you have a location where I can do it?
we have 30 locations. You can find one that's close to you. On that slide that we had up about our tax locations,
Can I get
flat
that slide so I can screenshot it?
the phone number you would call is 347-682-5606 for Grow Brooklyn.
And
Oh, okay.
you can also go to ios.gov/ VIDA,
Right.
and
Mm-hmm.
then you enter your zip code. It will tell you exactly where you can go.
Okay, got it. Thanks.
Mhm.
Makila also just dropped a link in the chat to Grow Brooklyn's website, where I believe you can also sign up.
Very nice. So
So again,
I wanted to touch base about something that Makila said. This is very important. This is an issue that we don't talk about from the refund of offset. That's happened every day. And me, when I was working in the tax office, a gentleman come, newlywed, come, he just get married, and then he said that he has a refund, but he never received the refund. When I checked the system, I saw the refund was offset and goes to for child support. And then since that day, the newlywed woman, the wife, knows the news. I believe they get divorced, maybe. So that's a very important. But there's something you can do if you receive offset. Your refund is being offset. Either you being a innocent spouses, you feel the tax with your husband or your wife, and then you realize that this is not your fault. There's a form that you can fill out to bypass the offset. And if you've been a victim of ID theft as well, you can bypass the offset situation. And I believe I have the form. The form is 8379. It's called injured spouses. They also have innocent spouses. Those are the situations that you're not responsible. You've been in a victim of ID theft, and then you've been in a hardship situations. You have no sources of income, or you have then you can claim innocent spouses so that they can bypass the offset for you. Okay, because the offset is part of the Treasury Department at the Bureau of Fiscal Services. It's not part of IRS. But when your refund is being offset, you expect it. This is not a pleasant situation. So I don't want anybody to suffer that. But don't forget, as a taxpayer, you have the right to be informed. IRS will never take a decisions without letting you being informed. And sometimes they send you one or two, three letters to make sure you're informed about your situation. And if you move from where you used to live, you can also file a 8822 to change your address to send it to IRS to make sure that the IRS know where you are. If you have an IP pen as well, and every year they send the IP pen, you want to make sure that you receive your IP pen by December. You should send the form 8822 for individual, 1822B for business. You send it to IRS to make sure that IRS know where you're working. They can locate you. All right?
Thank you, Max, for highlighting and underscoring all of those very important components. We have another question in the chat. It's a little long, so I'm going to try to paraphrase a little bit. So this person is an independent contractor doing freelance work. Last year, he used a 1099 from PayPal to submit his taxes, but this year, because of the one big beautiful bill, they say that he's not qualified for the 1099 form because he doesn't meet the 20K plus 200 transactions per year. So, does he just use his records from his PayPal account? The total he received as an independent contractor, is that the way to go?
Yes. Yeah, he still has to file his taxes, so he will just he's the record keeper because it's his business. So he goes off of the records that he has kept to file his taxes. So he will also have to, of course, have records for expenses and stuff like that if they were expenses.
And this is correct. And even though, like she was saying before, the tax requirement, all right, the IRS tell you exactly your tax requirement, but the law doesn't tell you when you're not required to file the tax. If you're not required, that doesn't mean you cannot do your tax. All right. If they say that $15,000 for individual taxpayer, but if you make 10, you can still do in your tax because the law doesn't stop you to file your tax. But there's a tax requirement. If you have a tax requirement, you are liable to do your tax.
Thank you both. Any remaining questions? It seems like we're all caught up in the chat. You can also raise your hand if you'd like to ask your question verbally. I'll give us just a few seconds for any last questions. All right, I think that's all for now. Again, if any question arises later on, you can always feel free to reach out to us at the contact information that's on our slides. And again, we will be sending out a recording of this presentation as well as the slides so that you can look back at it. You'll have our contact information as well as all of those helpful links that our presenters included in the slide. So as a reminder, we do have one more webinar in this tax series where we'll talk about self-employment and avoiding tax problems. So if this sounds like you, please join us next Wednesday at 6 p.m. for our webinar. If you need the link to sign up, that is in the chat right now. So before we conclude, do we have any last words from our presenters?
You ask us.
Yeah, just if you
Well,
wanted to say any final few
anyway,
words, it's okay if not.
that was wonderful, especially Miss Smart. Miss Smart may make sure that you remember to keep your record. Record keeping is the most important thing for your tax, especially if you plan to do itemized deductions. All right. So that's because when she said that, I feel like this is something that I need to note. And this is for you to note because this is very important. Record keeping, and especially when there is like a hardship, when there is like a season disaster, when there is disaster declaration, I always send them because they send it to me. I send them to my partners, so they know that happened. But make sure that you keep your record, like she mentioned before, and that's what gonna open the door for you. Imagine that you've been audited. It's not a bad thing being audited, but they just want to trust and verify. So make sure you keep your record. Thank you very much.
All right. Well, thank you again, Max, Makila, Takia, Kelly, for such an informative webinar. Great information tonight. And thank you, everyone, who, again, for joining us tonight. I hope you all have a great evening.